Welcome to Cambridge House Live. I'm Bridget Anderson and I'm joined by John Kaiser, the creator of the Kaiser Bottom Fishing Report. Nice to see you again.
Bridget, it's great to be here again.
Let's start off with 2014. What is your outlook for this year?
Well, the 3-year bear market that started in 2011, the big downtrend is over. Now we are seeing a selective bull market in the resource juniors. Nothing spectacular. There are still 600 plus companies with negative working capital which are going to continue to fade away. But the survivors are now rising from the battlefield. The audience is taking note and they're starting to accumulate on the ask side rather than sit on the bid side waiting for liquidators to dump shares.
And is this just a timing factor? There's some other reasons for this catalyst, do you think, then?
Well, one of the bad things about last year was that gold's pullback from 1900 all the way back to 1192, and now it's stuck at sort of 1250. That was very demoralizing for the sector because much of the momentum was premised on this idea that gold was going to breach $2,000, at which point it would be a very significant real price increase, and a lot of these projects would be in the money and everybody would make a huge score on the resource sector. That did not happen. The decline is over. The banks are still saying, yes, $1,000 gold is obsolete and so on, but they're wrong. The market knows it, and now we're seeing the hostile takeover bids like Corp going for Cisco, cleaning up these oversold assets before they get repriced on the upside.
So you see that as, particularly Goldcorp's move, as a real signal to the market then?
Yes, there was a great effort to get gold to close the year down below 1,200, which they just managed to, they just couldn't do it. And I think that's it. They've had 2 tries to get it down to 1,100. China just gobbles up the gold, and there's no physical gold around. And frankly, in terms of real price, even though we have $1,200 gold, we are exactly where we were in $400 in 1980 if you inflation adjust it, except that it's worse because in the mining sector, the inflation has been higher than the CPI that I use to inflation adjust gold. And in 1980, that was a 400% increase. We mined 2.3 billion ounces of low-hanging fruit that used to be high-hanging. There's no low-hanging fruit left. It's all high-hanging. So if the world wants more gold than the 5.5 trillion or billion ounces that exist now, it's going to have to mine them or pay a lot more for the ounces.
So do you see a big move in gold in 2014?
I see gold getting back into the 2013-15 range. The key thing is the gold market has to accept that gold is not inversely related to the business cycle, that a strengthening American economy does not eliminate the rationale for owning gold as a long-term hedge against uncertainty.
So John, what do you see happening on the U.S. economy then?
I think as they resolve this dysfunctionality that has kept the country from getting any traction, the American economy will start to grow. China's growth has slowed down. It's now dealing with internal problems such as its shadow banking system and its credit problems, also their environmental problems. The great migration of people from the hinterland to the city, providing an endless stream of cheap labor, that has ended. The cost of production is rising in China. China's asserting its footprint in the South China Sea, the East China Sea, trying to push America out of its dominance in this area. All of this becomes a rationale for rethinking the location of manufacturing in China. So we'll see something of a manufacturing renaissance in the United States, not very labor intensive, highly automated, but the Chinese just don't have the option of automating themselves the way America does.
And what are your thoughts on the tapering we're seeing around quantitative easing?
Tapering is extremely bullish because it has been an intravenous feed that you give a patient who is bedbound. And now that the patient is finally being weaned off this, there's a chance that this patient is robust enough to grow and move around again. It is a difficult transition, but it wasn't a sustainable model. In my view, they should have done old-fashioned Keynesian stimulus and built infrastructure and stuff so that the debt created was going to serve the people who are stuck paying it off decades from now.
So is the Fed going far enough then, or should the tapering be even more severe?
they have to be very careful because of the market, that the system's addicted to it. If they do it too quickly, you get a panic sell-off. I mean, if you're owning a bunch of bonds and they're yielding 2% or something like that, and you're going to see that rates rise to 6%, you're facing a big hit. So do you want to be the chump who keeps holding the bonds as they go down in value? They have to do this very slowly and carefully so as not to precipitate a very destabilizing sell-off.
I want to ask you about the retail investor exemptions, because you've been talking about this recently. Can you explain a little bit what this is first as a starting point?
Well, in this industry, there's something called a private placement, which allows an individual to give money directly to a company in exchange for shares and usually a warrant and sometimes a flow-through benefit. And the Canadian Resource Juniors, they've raised $37 billion through private placements since 2002. The problem is you have to be a millionaire to be eligible to do this, and you can't include the equity in your home, in your principal home. It has to be net worth outside of that, and that's a fairly small group. So all these people here, like say at this conference, the majority of them probably do not formally qualify, so they can only give money to existing shareholders or short sellers by buying in the open market, and they can do as much of that as they want. And it's completely insane that they can't put money directly into the treasuries as venture capital so that the companies can actually do something productive. And the institutional money is now gone because there's no expectation of higher metal prices in the near term of any consequence. The pool of accredited investors, they usually play this game by doing the private placement, and after 4 months, they sell the stock and clip the warrant as a free option on the fundamentals of the company. So they've been historically hanging the retail investor with the paper and the risk, and with all the elimination of the uptick rule and making it possible for short sellers, making it possible for professional traders to just suck money out of this market, the retail investor has become quite alienated and doesn't want to be in the aftermarket.
So this is significant.
It's very big. It's needed. And since we're past the resource feasibility demonstration stage where you take some old deposit found decades ago and you rethink it at $1,400 gold and say this can be put into production, we're not in that type of market anymore. That's what institutions like. Now we need to find stuff that works at the metal prices that we have. And that's the traditional exploration juniors such as we had in the 80s and 90s when there was retail capital available. Right. So the retail capital, which is very high risk but also offers very high returns when the company finally scores and makes a major discovery. And of course when there is one major discovery, everybody is me too, I have something similar, so it swells sideways and a lot of people make money through this sector. We need to have that capital flowing back into these treasuries, otherwise the system withers away, because it may be 5 years or so before institutional capital comes back for advanced projects.
Yeah, still a ways off. I want to ask you a couple more questions. In particular, I want to kind of drill down a little bit. So you were talking about zinc a little earlier on, and you were saying that you think it's poised for a meaningful move. So what do you think is going to trigger that?
Zinc has been in the doghouse for a very long time. It had a bit of a tag-along run during the boom in the last decade in 2006-07 before the financial crisis kicked in. But afterwards, while copper and gold and all these other metals recovered, zinc did not, because China ramped up production much better, higher than anybody expected. So zinc has been in this sort of 80 cents to 90 cents range for the last 5 years, where Western projects just don't work. And unlike all the other metals where there's a very broad base of mines and a lot in the development queue for copper and so on, there are very few zinc mines in the development queue, and there is a large number depleting in the next 5 years with no replacement. So the expectation is that the mountain in the zinc warehouse will take a year to draw down. Then we will start seeing zinc prices go up over $1.10. And the industry right now is already saying we need to start putting money into the advanced projects that are out there now and get all the other stuff out of the way so that when zinc's finally popping and the institutional money comes running, we are ready to spend that $20, $30, $40 million needed to bring it to a production decision.
And what about nickel? Because you've highlighted that as a potential speculative investment as well. So what do you see happening there?
With nickel has been burdened by the Chinese development of a way to feed nickel pig iron into their stainless steel mills. And they make nickel pig iron by importing raw ore from the Philippines and Indonesia. That's about 1.5% to 2% grade, and just throwing it into their blast furnaces. Indonesia has gone from, and Philippines have gone from being 4th, 5th place in production to 1st and 2nd place. And that has killed the nickel price. The normal producers that produce conventional laterite and sulfide deposits, they have not cut back. They have been losing money. But now Indonesia has put a ban on the export of the raw ore, trying to force the Chinese producers to build these blast furnaces inside Indonesia, so that a lot more of the markup can accrue to the Indonesian people rather than to the Chinese. That may take some of the lid off price of nickel, and it may go back to $8, $10, but it's not going to do a $20 to $25 move such as it did in 2007.
Okay, so nickel and zinc, and what about other metals? Are you keeping an eye out for 2014? Any other particular area?
Copper is expected to be in surplus and continue to be weak, but there are some complexities in the copper market which the market doesn't really understand. So we may see copper, at the very worst, stay where it is and continue to trend higher. We may see most of the big copper buyouts happened prior to 2009, and there have not been a lot since then. There's a few advanced copper product deposits left, but what the supply and demand people are saying that we need to think about 2017 and beyond. And because it takes so long to put a copper deposit into production, there's now an argument to explore for copper deposits and looking for the really low grade, sitting on them. That might be one way, but nobody's going to be excited about that. But risk capital may become available for exploring for higher grade copper deposits that in 2017 and beyond are production candidates.
All right, we'll leave it there. Thanks very much, John.
Thank you, Bridget.